Hi folks, you're tuned into BT Classroom with me, Sakshi on Business Today TV. Why investing in passive mutual funds could be a good idea for you? Well, mutual funds are one of the best market-linked investment vehicles for investors, as we've heard most of the experts talk about. Generally, they offer diversification of risk with the potential to generate high returns in the long term. However, often investors really get confused about where to invest the hard-earned money, especially given the variety of funds currently available in the market. So let's go down to discussing passive mutual funds and why should you as an investor consider this as a part of your portfolio. So what is a passive mutual fund, first of all? In the case of an active mutual fund, it is managed by a fund manager who is responsible for doing the research, selecting the stocks and proportion of the investment in each stock or a sector, and then monitor the performance of the fund on a periodic balancing of it as well. However, in case of a passive mutual fund, the fund manager does not perform all of these activities, especially when it comes to stock selection, as mutual funds construct their portfolio by tracking the market index or a specific market segment. Unlike the active funds, there is no need to do any research to identify the stocks to be part of the fund portfolio. The fund manager will simply construct the portfolio by mimicking the index composition, something like a Sensex or a Nifty composition. Now, thus, these returns are actually close to just the market returns. Overall, you don't get to generate a lot of alpha right there. Types of passive funds is something that you should now get to know about. The first type of passive fund is an exchange traded fund or an ETF. Now, ETFs are a type of passive funds wherein the ETFs are pooled investments which are created to track the benchmark index or a particular sector. Another type is that of index funds which are created to just replicate specific index or a sub-index or a sector. Now, this could also be a fund of fund, which are actually mutual funds that also invest in the units of other mutual funds. Now, rather than buying different types of securities such as shares, bonds, etc. Themselves, this could be a smart beta way in which you can actually invest, get the benefit and not get into the nitty-gritties of how to select stock, how to select a fund manager right there as well, and look at the other things. So this is a plain Jane simple way of investing in a mutual fund. Now remember that smart beta funds are also an extension of ETFs that do not aim at just replicating the index but also select the individual securities based on various parameters such as volatility, value, growth, momentum. So smart beta ETFs are actually a mix of passive investing approaches with some of the elements of active selection as well. So in case you want the best of both, this is something that you can look at. Now there are both advantages and limitations of investing in passive funds. Now, to understand whether the passive investment funds are actually right for you, you need to know the advantages and limitations, both of them. The major advantage of passive funds is that they have lower expense ratios. No human bias will get into reflection of the stock selection right there, and besides, better transparency and ease of investment is also being seen here. However, the major limitation of a passive fund is that they have no potential to outperform the market, as they are simply tracking the index or a benchmark itself. For instance, an active fund manager may actually take investment calls and adjust the weightage of the shares of the portfolio according to their convictions to really beat the benchmark index, which is not feasible in a passive fund. Now, when we talk about risk and returns, passive funds are riskier because they are just market-linked securities, and thus any swings in the index will have a huge impact on the fund that you will be investing in. Investments in any type of mutual fund, whether it is active or passive, is actually subject to market risk, and that all of us know. So investors must choose index fund or an ETF that provides suitable risk to reward opportunities to you as an individual capacity taker of risk when it comes to investing in mutual funds.
If you like the video, do like, comment, share and subscribe.